Welcome to another edition of Mwango Spaces, where we have really good discussions around capital markets and businesses around East Africa. We love hosting both the people who are building businesses and those who are providing the capital for businesses. So our guest today gets to do both at the same time. So this is a very interesting discussion on what he's building. So without further ado, I want to welcome our guest today, give him a few minutes to introduce himself and what he's doing. Then we dig into much more of the concept that he's implementing. Welcome, Looney.
Hi, thank you for having me. My name is Looney Livis. I am a serial entrepreneur. I have been building businesses since 1992. And these days I've been building businesses that invest in companies in Africa. Been doing that for over a decade now. Got here by creating a business accelerator that was focused on mission-driven for-profit companies. That was called Fledge. That got started in 2012. And then in 2020, we spun off Africa Eats. So we took the graduates of this program that were in Africa doing food and ag supply chain companies. We wrapped them in a new structure, which is the basic topic of tonight, and started investing in them and growing them much quicker than before in the accelerator model. And then we took that all public.
Let's start from you. What's your background? Did you study business and what's got you into entrepreneurship?
Oh, I love this one because I taught at a business school for 9 years. I taught entrepreneurship, surprise. I taught MBA candidates, as we call them. And whenever I started one of those classes, I always used to point out that I've never taken a business class. Africa Eats is company number 8 for me in terms of a sequence of startups. No, Fledge was 8, Africa Eats was 9, Tuesday Markets is number 10. So I learned business by doing business. I studied computer science and mathematics as my university work.
Was that learning curve steep from mathematics and all that to business? It sounds like business is usually either simpler or harder for some people.
It's been a long time. Again, in 1992, I started my first company, wrote the business plan in 91. My wife and I joke about the family businesses. So she's a university professor, second generation teacher. I'm an entrepreneur. I don't even know how many generations back my family was entrepreneuring. That's just what we do. Nothing of the scale that I'm doing now, not in Africa at all. But the idea of start your own company, that's not a scary thing to do in my family.
How do you perhaps move from just starting the business? Usually people have a lot of excuses. I don't have the money, the capital. What does it take to start a business from your experience?
Great idea. Not a good idea, but a great idea, which are really rare. It takes a plan to get it off the ground, to get something in the market you can sell. And usually that means you need some capital to get it going, but not always. And then you wake up in the morning thinking about your company, you go to sleep at night thinking about your company. You just live and dream that company for a few years to get it to a scale where you can finally enjoy life and work. And then by the time I used to get it there, I used to leave and do the next one. And so that's really what it takes. It doesn't matter whether that's software or bananas. The same thing applies.
What's the difference between a great idea and a good idea?
A good idea is one that came to your mind. You saw some issue, you're trying to solve it. Other people could have the same idea. Great ideas have some novelty around them. Or no one's doing it in the space. You've seen the model work somewhere else. You bring it to someplace that hasn't been done before. But ultimately, it boils down to customers really want what you're selling. Like what you're doing is resonating with the customers, the paying customers. And the first-time entrepreneurs generally don't understand that. They settle for their good idea. They don't throw away plan A fast enough to get to something that's actually great. This is why a lot of startups fail.
And then part of that is also, of course, throwing away bad ideas means that you implement one. If it doesn't work, you move on to the next idea. Is that how it works?
No, a lot of people do that. It's not throwing away the idea. It's iterating on it to find something that works. And again, the kind of companies we're investing in Africa these days, it's tweaking the model a little bit. It's like you think all you're going to do is find some farmers that are growing maize. You're going to make fortified maize flour. Okay, that's a good idea. As long as you're in a country where that's not a common thing. That's a good idea. That's fine. You can make a decent living doing that. But how do you then tweak that so that you have a business that grows 100-fold in 5 years? And so we've invested in a company that did that. Or chickens are pretty popular. How do we scale up chickens to the scale where in a single country, we make a noticeable decrease in the price of chickens just from the operations of one company? Like, how do you get enough demand to do that? or sometimes it's just something you need. It's something you personally are experiencing. It's really common across Africa to hire the guy with the truck. But what happens when you need 3 trucks and there isn't 3 guys with 3 trucks who can reliably come? How do you solve that problem? And then literally the next thing you know, 4 or 5 years later, you got a $10 million a year business. So yeah, that's a mix of the great idea and the iteration and just keeping on it as opposed to giving up when it seems tough, when no one wants it, as opposed to refining it until you find that thing that transforms it from good to great.
That brings me to the next question, which is what about Africa interests you as a market? And then link that a bit to your interest in Berkshire Hathaway.
Okay, that's a stretch, but give me a second here. All right, Africa was an accident. I was running a business accelerator in Seattle, Washington, USA, far Pacific coast, as far away from Africa as you can get and be American except Hawaiians. And most of the companies that were applying were from that region of the world. And then I stumbled across a website. I was looking for websites that had lists of startups. And I stumbled across what was then a brand new website, which today is VC for A, but back then was VC for Africa. And it had a list of 1,000 companies. So I just opened it up and subscribed, paid them a small fee, and read 1,000 profiles of 1,000 companies in the next 4 hours. Really short, like as fast as I could. And in there was a bunch of companies that looked interesting. So I reached out to them and said, have you ever considered working with a business accelerator? This was 2014, and there weren't really business accelerators in Africa. So some of them wrote back saying, that's interesting. How's that work? And so forth. And a few applied. And in this cohort, it was the 4th cohort ever of Fledge, year 2.5. We invited 3 out of 6 companies doing business in Tanzania just to see what would happen. It just looked interesting. It looked like these were 3 good companies. And that was the last time the majority of companies in Fledge Seattle weren't African. Like it just kept building from there. They kept coming and coming. And so why did we keep accepting African companies? That's the key question here. And there's a long answer to that. Part of the answer is the accelerator is a venture capital fund. It didn't have a lot of money. It was a little tiny seed capital fund. So we couldn't compete in the US writing $500,000 checks or $1 million checks. We were an accelerator writing $20,000 checks, just like Y Combinator was doing at the time. And so $20,000 to an American company makes a teeny bit of difference. $20,000 to a young African company makes a huge difference. So all of a sudden, we're a big investor, even though we're writing small checks. And then the other piece, the most important of this is, as I said, great idea. It needs to be something no one else is doing. And in my classes, when I was teaching the MBAs, in day 1, I would tell them, you don't need to bring an idea to class. We're going to do that on day 1. And in 10 minutes, we would fill a whiteboard with business ideas. And there would be a single idea in 10 minutes that wasn't being done somewhere in the United States. It's 300 million people. Ideas are a dime a dozen. Entrepreneurs are plentiful. Most ideas are being done by multiple groups at any one time. And yet in Africa, when that first company that I came across that applied was simply aggregating food from farmers and delivering to restaurants, and no one else was doing that at scale in Tanzania. By the time we finished the program, they were the largest of that type of company in the whole country of Tanzania at $100,000 a year. There's nothing equivalent to that in the States. Rarely. It happens once in a while, but really rarely. And so this company didn't have to come up with a brand new idea and any humongous innovation. The company's evolved since then. Evolved and iterated is important. It's not doing the same business it was doing in 2014, but it's now doing $18 million worth of business in Tanzania, and it's by far the largest of its kind. And so it's that opportunity size that ultimately pulled me into Africa. And then lastly, there's an impact part to it. So what I didn't say was that this business school I was teaching at was the first business school in the world to teach how to do good through the tools of business school, how to solve real problems. And so at Africa Eats, we are an impact investor and we make money. And on the impact side, we lower hunger and poverty across Africa. And we do that by making investments. It's easier to make impact in Africa than anywhere else that I know of. And so Berkshire Hathaway. So I'm running a VC fund in the States, a little, again, micro VC fund, but nonetheless, following a VC path. And of the graduates of Fledge, we invested in about 100 companies in 8 years, more than half in the States, the other half scattered around the world, large number in Africa. And I was looking back while in year 8 and looking at where the successes and failures were. Where was the follow-on capital showing up and where was it not? And almost exclusively, but with a few exceptions, there was no follow-on capital to these great companies I was finding in Africa. So we were investing. We might even write a second and third small check, but no other institutions were showing up to invest in these companies. So I said, great, there's an opportunity there. There's a need. These are great companies if only they had the resources. Why don't we do this? Why don't we take them out of the VC fund? Because that's not attracting capital in that form. Why don't we wrap them in something new, in what became Africa Eats? We'll spin it out of Fledge into its own thing, and then we'll go raise capital as Africa Eats. And so you wind up business modeling just like entrepreneurs do. It's just a finance company. And the first and biggest question, because we already had a portfolio. So normally the question is, what kind of companies will we invest in? We didn't have that question. We already had the companies. Question was, how do we get our investors' money out? How do they earn money if we're investing in a part of the world that really doesn't have any exits? We did only food companies. We took only the food companies out of the Pledge portfolio. So how do you invest in food companies in Africa where when you look around, very few food companies ever get acquired and none go public, right? So there's no exits. And you have to iterate on your plan. And so I looked for what other investment model can I find that succeeded in the world that isn't based on the VC model of exits. And 7th most valuable public company is Berkshire Hathaway. So I dug deep into how does that work? Because they buy companies and never sell them. And so ultimately, the short version is we invest in companies and we never sell them, but we're highly successful nonetheless, and our investors are really happy.
I get now your interest in Africa and Berkshire Hathaway in terms of building the model. Now, please break down for us how Africa Eats is structured currently as it is, and then break it down for us to the individual companies that you have in the component companies.
Africa Eats is an investment company. We are shareholder owned. So we're just a company like any other company. We're shareholders. We're domiciled in the Republic of Mauritius. That was on purpose. This is Africa Eats. We're trying to feed Africa. We're trying to solve poverty. And we wanted it to be an African company. And if you're going to be a Pan-African company, the best place to organize is Mauritius. We are a publicly listed company in Mauritius as of December last year. And we own minority interests in 23 companies operating in 8 countries across the continent. So Fledge found these companies, or almost all these companies. Fledge invested, and then Fledge traded those investments to Africa Eats for shares. And prior to going public, Fledge distributed all of its shares of Africa Eats to all of its investors. So they're now all direct shareholders of Africa Eats. In the listing process, we added a few dozen more investors. And again, we're publicly listed. We have 180 something shareholders. There's a public list that sits here in this country. And our goal is to grow the companies and to add more companies and have them have more impact while they are growing and making profits and solving real problems.
For most people, I find like the goals of building companies and impact are divergent in a way. How come those two intersect for you, and how has that worked out in practice?
I went pretty deep into how mission-driven or impact companies work back when I started teaching. That was 2012. It was the same year I started Fledge. There's basically 3 models of impact companies. And the poster child for the first one is Ben & Jerry's ice cream in the States, which now is owned by Unilever. And that model is bring a product to market. The product itself can be unhealthy, like ice cream. Doesn't matter. Can harm the environment even. Doesn't matter. Give a percentage of the profits to charity. Ben & Jerry's is considered an impact company because they give 15% of their profits to charity. To me, that's a charity. And I do love their ice cream, but I don't buy their ice cream because it's impactful. I buy their ice cream because it tastes great. We don't invest in any companies like that. Those are charities. Second kind, the poster child is Warby Parker. They're an eyeglass manufacturer. And so they sell eyeglasses in the States for not too expensive, more than it costs them to make the glasses. They don't give away eyeglasses in emerging markets. I think they do eye operations to help people. And again, it's charity. It's like the buy one, give one model. Tom's Shoes used to be the other poster child here. You buy an expensive pair of shoes in the States, they give a pair of shoes, not the same shoes, a cheaper pair of shoes to someone in an emerging market. It's a charity. People buy those products because the products are good, but they overpay what the product is worth so that there's a charitable cause. It's a charity. I would never invest in one of those companies either. The third one is the only model that I do invest in. In that model, the mission is embedded in the product or service. So I said about 2 or 3 times here, Africa Eats tackles hunger and poverty. How do we do that? We invest in companies that buy food from smallholder farmers. That's the impact. So when one of my companies like Swahili Honey in Tanzania buys honey from smallholder farmers across Tanzania, those farmers now have a cash income. They're no longer subsistence farmers. They're no longer poor on the World Bank measure of poor. We have, I don't want to say solved, that's a strong word, but we have made a dent in poverty for those farmers and every other farmer that works with all the other companies. And then when it comes to hunger, honey never goes bad, so they don't have post-harvest losses. But for the company that aggregates bananas, a large percentage of bananas in the traditional food supply chain get crushed, go bad, rot, never make it to market. And in our supply chain that we're funding, a small percentage, a very small percentage, are already rotted when we pick them up. And nearly everything makes it to market. So we're providing more food to market. And so those are the impacts that our companies have. And therefore, when those companies double in size, their impacts double in size. When those companies grow 50-fold and 100-fold, which some of them have, then their impacts have grown 50-fold and 100-fold. And all the managers have to do to have those impacts is grow the company. And that's what they wanted to do anyway. They're all entrepreneurs. They all want to have a bigger company. And so they're just focused on the business and the impact just happens. Right? It's built into the model.
Could you take us a bit to the portfolio of companies that you own, what they invest in, and maybe high-level financials, maybe for their main listed entity?
Okay, so 23 companies in the active portfolio, soon to be 24. Again, it will keep going up. Occasionally you have a failure, it goes back down. We don't have a bound. There's no maximum number we're going to invest in. They're in 8 countries. The biggest ones are in Tanzania, Rwanda, Uganda, and Malawi. But we also have Kenya covered, Zambia, Botswana, Ethiopia, and Ghana. Why those? Those are the ones that happen to apply to Fledge. We don't pick the countries, we pick the companies. That happens to be where they're operating. The first investment from Fledge was in 2014. Our year one, when we count history, is 2014. Total revenues of all the companies that existed back in 2014 was $600,000. Total annual revenues of all 7, 8, 9 companies that existed was all of $600,000. So we're talking about a large, very small companies. And the companies have shown up along the way. We just count their history from when they started, not from when we invested. Total revenues of the 23 companies in 2024 is $44 million. So we've seen these companies grow from $600,000 to $44 million in 11 years. It's a compounded growth rate of 55%. And that's the growth rate that we look at for a succeeding investee. So they should be growing at 50% to 100% year over year for many years. Some of them grow faster than that because our average is 55, and not all of them do because not everybody succeeds. And what they do, most of them are aggregators of smallholder farmer outputs that they pick a crop or two, and that can be potatoes or onions or bananas or maize or rice or beans or just everyday foods. We don't do cash crops. 5 of our companies aggregate honey and beeswax, and then a few of our companies sell to farmers. So we have 2 companies that do agrovet supplies. We have 1 company that sells seeds in a very novel fashion. We have 1 company that makes cook stoves. And I feel like I'm missing something in there. But generally, the model is work with smallholder farmers, mostly creating incomes by buying their outputs, occasionally increasing their incomes by selling them something that increases their incomes of animal medicines or seeds.
So when these companies come to you, what's a missing thing about them that makes them, once you get them into the portfolio, they're able to scale that fast?
There's definitely a component of capital in there, but we're not VCs. We're not funding the Twigas of the world. If there's some Kenyans on this call, we're not dropping $50 million on a company hoping they'll figure out what to do with it that's wise. We are typically writing a small check like $50,000, $60,000, $75,000 to a young company that's doing about that revenue or $100,000 or $200,000 in revenue, where something's in the way that's stopping them from doubling in size. It could be a lack of equipment. It could be a lack of formal procedures. They just don't know how to do financial management. They're missing a key person on their staff, like an ops person or a salesperson. And so the typical question that we have for someone new is, what do you need to double? what's in the way to get you to double? What are the top 3 challenges? And then we will work with them, including a capital investment, an equity capital investment. But then we'll work with them on top of that to solve those other issues. And then one of the key pieces to why our companies grow so fast is that we know what their next challenges are going to be. We've seen this 24 times already. So if you bring to me a food and ag company from anywhere in Africa, it doesn't really matter, and they're aggregating some everyday product and they're at, let's just say, $200,000 a year, we can list 3 or 4 or 5 likely things that are going to get in the way of them getting to $400,000 or $500,000 in the next 2 years. And so we can get ahead of the curve and we can teach them how to get there. We can handhold them through formalizing their practices, because no one runs a formal business at $200,000 or $100,000. We have a lot of stories about $24,000, $30,000, so even smaller companies. And so we're there working with them in order to deal with those challenges. And then the other one that's invisible, except we keep talking about it, is that we have a network of 25 entrepreneurs. And so many times the challenge comes along. It can be dealing with the farmers, it can be dealing with the retailers, it can be dealing with the guys with the truck, it can be power issues, it can be lots of things. But almost always someone else in the network has already had that challenge and solved it, if not 5 of them. And so the answers to what's the best way through this particular current issue, it can come from the fellow investees, we call them BZ, by the way, the investees. It can come from other BZ founders, and often does. And these days, that's running at a scale where often the BZ founder doesn't even bother to tell us. They'll just get an answer from someone else in the network.
So it's like you're building a self-reinforcing kind of business model. So like they learn from each other, they're able to grow together and leverage each other's networks to grow. So I wanted to ask maybe, what are some of the top issues that most companies that come to you, you've seen them struggle with? And then, because most entrepreneurs talk of capital being the main hindrance, but what are the other small issues that you've seen that maybe if worked on, entrepreneurs can be able to scale their businesses?
Yeah, formalizing business practices is probably the number one issue. And first-time entrepreneurs often don't know what a formal business looks like. Like they know how to run a company, especially the founders we're talking about. They know how to run a company in their gut, and then they know how to run it in QuickBooks, but they don't know what comes after that. And again, we're working with pretty small companies when we first meet them, right? 10 of them are above $1 million in annual revenues now, but they don't know how to run $10 million a year businesses, or at least 8 of them don't. And so the next challenge of that is just finding that next staff member who can help do that. And that can be an ops person, a salesperson, a finance person, a product person, to hire that next person who can get the company to be 3 or 4 or 5 times bigger. And so often they don't know how to find that person, or they just can't afford that person. And we will work with them to fill in that gap, including providing the capital to hire them before they would otherwise be able to afford them. Next biggest is operational capital. And so banks, of course, don't provide operational capital in Africa. It's very hard to scale a company. If you double the revenues, you're very likely doubling the need for operational capital. If you're doubling the revenues, typically you need twice as much equipment. But you can't get equipment finance either, so we have to help fill in that gap as well. And we have some interesting strategies we use to try and minimize that. We've had some success stories from our companies on how they've managed to grow without having to double their operational capital. Again, that information gets shared between the founders. And how to deal with other investors as well. The 50 to 100 institutional investors that invest in this space across Africa, they generally don't look at companies till they're past $1 million in annual revenues. So our biggest goal when we meet a new company is, how do we get you past $1 million in annual revenues? So we'll often fund to that scale. And then we want to pull back at that point in terms of our financial contribution and bring in other investors who can bring in more network and more help. And so we're hand-holding our entrepreneurs when they're talking to the next investors. And we're negotiating, sitting on the company side of the table. At the same time, we're introducing them to these institutions who are now literally reaching out to us a few times a year going, what else you got? I just invested in one of your guys. What else you got? Who do you have next I can go talk to? So there's a lot of that as well. There's the network of investors talking to investors, and we're plugged into that.
The Berkshire model also leaves the management teams intact. They don't really interfere with that. Is that also your model in terms of running these businesses? Are you hands-on in terms of the holding company to the portfolio companies, or are you more or less like seated back and letting them run the show a bit? I get a bit of networking and hand-holding that needs to happen at some point, but how do you balance that out?
These are not our companies. These are their companies. There's a lot of ways to look at this. Whenever we do a in-person gathering, I always note to the audience, we always have outsiders. Africa Eats is all of the companies and the little team that runs Africa Eats. That is what Africa Eats is. But these are our companies like it's our family. The founders run their own companies. They are the CEOs. They hire the management staff. They do the day-to-day work. It's their companies. They're majority owners. We're never majority owners. We're here to support the CEOs, the co-founders, the management team as needed in order to help them run a bigger company and grow their companies. You can't ask me where any of my companies sell products. I don't know. You can't ask me how many chickens were sold last week. I have no idea. That's not the level we're interacting at. We're acting at the management level and the strategy level.
All right. And then in terms of exits, what if the founders want to exit from some of these companies and sell them? They're getting older. And I know some of the companies around Africa struggle with that, maybe transitioning the company from first generation founders to the next generation. How do you help these companies and how can they exit in your portfolio?
I think our median founder age is probably 35 at this point. I think we're one over 40. The ones we pick tend to be in their 20s when they started. So nobody is telling me that they're ready to move on. We fly everybody, all of our founders, to Nairobi once a year. We meet in person. It's part of our internal networking. It's also to show off. We have guests that come in and we show off. I can see some of the guests on this call. And we asked to show of hands. We've done this a few times, but the last gathering was April in Nairobi. And I think we had 80 people in the room, 30 of them founders, 5 or 6 guest founders. And I said, stand up if you're a founder. Stay standing if you have a desire to sell your company in the next 10 years. And what's surprising to my American shareholders and the VC crowd I used to hang out with and whatnot is no one was standing. Everybody sat down. Not a single entrepreneur who was in the room has a desire to exit their company in the next 10 years. They all want to build something that's much, much bigger. That said, one of the ones that does want to sell their company in 10 years just wasn't there. He was busy with other investors. So he would have stayed standing. And I'm in my 50s. I've done this many times. I know that there will come a time when an entrepreneur says, I'm good. I'm ready to exit. And at that point, we will help them hire an investment bank to go find a buyer. We don't do that part. But there are other companies out there that will find buyers. And when they're ready to go, they can go. Again, it's their companies. They control those companies. And at that point, it's fine. I'll take a 30x or 40x or 100x return on the investment we made when they were much smaller and recycle that and go do some more companies. But we have no intention of ever selling any of our shares. We're not planning on shopping our shares to a private equity firm or family office or anything like that of these investees. Somebody wants to invest in Africa Eats, they can buy shares of Africa Eats and own a little bit of everybody. But just like Berkshire, once we like a company, we just keep it forever.
And then in terms of listing, and I know Africa Eats itself is listed. The various portfolio companies, do you encourage them to list also?
So we listed 2 of them last year on the same day as Africa Eats, in the same listing process as Africa Eats. And we don't tout it too much, but by the way, that's never been done before. There's never been a group of companies that listed together on a single day in a single process on a single stock exchange. So a lot of people looked at us strange for doing it that way, but that was the right thing to do. And so we chose purposefully the 2 smallest companies whose revenues were past $1 million a year. Painel Meat Processing, which is listed as Elite Meat, and Zoeto, Zoeto Enterprise, which is listed as Zoeto Holdings. And our plan is to list more, 1 or 2 more each year, every year. And the reason why we went through that process is because there's far more capital in the public equity markets than the private equity markets. And so despite all this success, despite everything I've told you, the growth for 50% per year and 44 million of revenues, it's not like investors are throwing money at us left and right. And they're not throwing money at these companies at all, left and right. And so in order to find more capital to continue this growth and grow the whole system, we're tapping into the public capital markets. And that worked for the first 2 that listed. And so the 3rd one's in process now. We'll do a 4th one sometime next year, maybe even 2 next year. And then we'll just keep taking our success stories to the public markets, using that money to scale them up further.
And I know along the way, I think I've worked with you for 2 years now. You've met quite a bit of challenges. And one thing I've liked about you and the way you approach businesses is that along the way, as you meet problems, especially in capital markets, you're trying to solve them actively. I think one was the listing process itself in terms of exposure, trading in dollars versus local currency. So maybe you can highlight a bit how that experience was and your reflections around the listing process. And then we'll come later to discuss the liquidity aspect of it.
Most entrepreneurs, most people who are solving a problem tend to look at it as, what's my problem? How do I solve my problem? Part of the role I play in helping 24 other companies is just having this idea of, how do we solve our problem? How do we solve a problem that covers all these companies? And then I take it one step further, which is, what's the best way to solve this for every SME in Africa? And literally, if my 23 companies have this issue of raising capital, and let's go look at the capital markets, how do we solve the problem of using the capital markets, not just to fund 23 companies, but to fund the tens of thousands, or maybe it's hundreds of thousands of succeeding SMEs across all of Africa? Given that question and working backwards, the answer is that SMEs don't list in Africa for a lot of reasons, but one of them is that the listings requirements don't fit the needs of SMEs. You have to sell 25% of your company on day one, or you have to have sold 25% of your company on day one. You have to have 250 shareholders. It's pretty onerous in order to list. So I reached out to the Stock Exchange of Mauritius, October 3rd, 2023. Remember the date. And I said, how about this? How about we create a section on your stock exchange? They call it a segment here. How do we create a segment on the stock exchange that's designed for fast-growing, profitable companies? And we want to be a higher bar than normal to list. So we want the normal listing requirements -1. We want only a 10% float. We want to sell 10% of the company to start with 100 shareholders. And in year 3, you got to get to 20 and 200. And in year 5, you have to get to the normal 25% and 250. So how do we wean our way into the full-scale listing requirements? But meanwhile, we want to set a premise that these companies on this segment, in order to qualify for this privilege, are growing at least 25% per year and are profitable and have been profitable. And the stock exchange surprisingly said, yeah, let's do that. So we worked with them for months to set these rules rulebook. They had to go get approval from their own board and from the regulator. It took a while to do that, but we got that done. And then the 3 companies listed on that segment. And we're working with other stock exchanges to do the same thing across the rest of the continent. And so far it's worked. We expect it to take a while until people have noticed and until others start following us onto this segment. But the premise is that there will be, in, let's call it 10, 15 years, there will be a large number of companies that are listed that all have to be fast growing and profitable to be on these segments, and therefore will attract the attention of more investors, and therefore will attract the capital of those investors. And lo and behold, we'll be funding succeeding SMEs in Africa. And so that's how we got to where we were, just thinking about the problem as a whole, as opposed to how do I fund Soweto in Malawi.
So listing is usually the first challenge. The next is trading. I think that's part of why you have Tuesday markets. Could you explain that a bit and how you've been trying to solve it, how that was a bottleneck?
So we had always expected to list Africa Eats. That was always the plan. And our expectations was that we would list somewhere in Africa. It would be a liquid. It would just be a way to raise some more capital. And we would solve the liquidity problem by getting big enough to list in London and New York, where there's liquid markets. Basically, called like 2 weeks later, October 3rd, we said yes. And I remember the date because it's 14 months to the day when we listed. So a few weeks after the SEM said, yeah, let's do that, then the next problem comes that the SEM, like every other African market, is illiquid. So how do you solve that problem? There's a player in the stock exchanges in New York and London and Europe and the other major exchanges called a market maker. It's invisible. Almost nobody knows what it is. Very few people know how it works. And what I learned subsequent to this is it's pretty much undocumented. There's no books that describe it. There's no blog posts that describe it. It's a black art. It's not difficult. It's rather simple, in fact. But nobody ever writes about it. They'll never write anything positive about it, and they never write how it works. So I just dove in to figure out how that works and came up with a business plan to create the first market maker in Africa. gave it a name. It's called Tuesday Markets. Got it funded separately from Africa Eats. And we launched. So the three companies that are listed here in Mauritius are completely liquid. So if you want to buy, you can buy 5 days a week. If you want to sell, you can sell 5 days a week. There's a company that makes that possible. And then it's not somewhat related to that, but not directly related to that. It's just the fact that it's hard to trade in Mauritius. It was hard to trade in Mauritius. There's 8 brokers. You got to set up a brokerage account like normal and blah, blah, blah. And there were no apps. So Tuesday Markets also got a partner that builds software. And we built the first app that lets you trade shares in Mauritius. Currently just 3 shares, just 3 different companies. That'll grow next year. But yeah, so anybody in the world who would like to buy or sell these shares, you go to Tuesday.Africa, you set up an account, you can buy and sell these shares. And it's completely liquid. If you don't like it after a day or a month or a year or 10 years, you put in a sell order and it will close that day.
And you have an intention of expanding this to Africa as a whole. You've also explored, I think, Kenya and Nairobi Securities Exchanges in the process. Share a bit about that also.
Yeah, the goal of Tuesday Markets is so it's a separate company from Africa Eats. It does not invest in food and ag. Its mission is to make the markets of Africa liquid. Big, giant, audacious goal. It might take us 30 or 40 years until we've made a noticeable dent in that, but that's our goal. And when we say Africa, we mean the continent. There's, I think, 18 stock exchanges, and we're not just limiting, when we say markets, we don't just mean stock exchanges. We'll do more than that. It takes a while to get there. So we started here in Mauritius. Next up is we're launching an equity ETF on the NSE in Kenya. So we will be launching the first Kenyan ETF, the first equity ETF with African stocks in it. And those stocks, surprise, will be these 3 or 4 companies in Mauritius, Africa Eats and its investees. And then we'll add more to it. But one other way to add liquidity and interest in stock exchanges everywhere is ETFs. There are more ETFs than stocks in the US. There's more ETFs than stocks in Europe. We're close to it. There's 99 ETFs in Johannesburg. There was 1 in Kenya when we started the process. Now there's 2, soon to be 3. There's only 3 in Mauritius. Most of the stock exchanges have 0. We're trying to open up the path for investors to come in and not have to pick individual stocks. The trend is for people to pick funds. And that's a Tuesday Markets project, not Africa Eats project.
And by the way, you call it Tuesday Markets because of the concept of people coming to the market on Tuesdays to meet, right?
Yeah, we had this idea that maybe one of the problems with the illiquidity of the African markets is that the markets are open like 5 or 6 hours a day, 5 days a week. And there aren't enough trades that even 2 trades happen in an hour for most stocks, Safaricom put aside. And so it's really hard. If you have a buyer on Monday at 10 a.m., and you have a seller on Wednesday at 4 p.m., it's asking a lot for those people to just leave their orders on the market. So we had a premise. We said, why don't we just concentrate all the orders to the end of day on Tuesdays? And this, again, the Stock Exchange of Mauritius was gracious enough to say, yeah, let's try that. It's a closing auction. It's half of all the shares in New York and Europe trade on the closing auction. We didn't invent this idea. We just said, let's just do it once a week instead of every day. If you use the Tuesday app, you can put in orders 24/7, 365, but they only get uploaded to the stock exchange between 2 p.m. and 2:30 p.m. on Tuesdays. And if you really want to trade another day, we'll help you do that. But the app itself only trades on Tuesdays. And that is working. That actually does what we intended it to do.
So going back a bit to how you structured Africa Eats itself. So you say there's a portfolio companies and then the holding company. So how does the holding company make money? Do you charge management fee? And then in terms of percentage ownership in portfolio companies, how does that look like? And then what percent do the founders, average founders in the companies, hold in the companies?
Technically, a holding company has to have majority interest or controlling interest. So we're not a holding company. We're just an investment company. Our median ownership is about 25%. It varies. We have some that are less and some that are more. We don't like to own more than 40%. I think we have 1 where we're over 40. We like the founders to have the majority of the shares and the vast majority of shares. And we don't charge any fees. We're a shareholder company. Our shareholders put money in the company by buying new shares when we issue new shares. We take that money, invest it in the companies, grow the value. Our balance sheet value keeps going up. So just like Berkshire Hathaway, investors are buying shares now, and today was $2.60. That's up from $1 5 years ago. So we're up 2.6x in 5 years and a month. 5 years a month in a few weeks. We expect that share price to continue going up. And so investors make money by selling shares whenever they feel like. And we're run at the moment by taking new capital from investors and growing the company. We expect starting probably next year to be on the way to self-sustaining, I'll say, by having our succeeding companies pay dividends to their shareholders, the public companies. And we are one of those shareholders. Therefore, we will receive cash from a share of the profits through dividends. And what I've promised my shareholders is that we will never pay a dividend. There's a long story on Berkshire Hathaway and Warren Buffett apologizing for paying the one dividend in 1967. So we're following that. I'm not going to explain that. It's late. But we will be recycling the capital back into new investments in order to raise the share price for as long as it keeps working. And at Berkshire Hathaway, it's been working for 61 years. Hopefully, I'm long dead before it stops working. And currently, in terms of share price appreciation, we only have a 5-year track record, not 60, but we're beating Berkshire Hathaway. That's our benchmark. Their 60-year compounded growth rate was 19.1% so far in over 60 years, or 26% per year for 5 years.
Thank you for sharing that. That's a high bar, though, in terms of Berkshire Hathaway, and I like that you're aspiring towards that. So coming back to the portfolio companies a little bit, what are some of the traits that you've seen in the successful entrepreneurs or in your portfolio in terms of scale? One of those that you talked about is that they're in it for the long term. What are some of the traits that you see in the successful ones? And part of your portfolio also has some of these companies that have not succeeded to grow at that fast. What are some of the traits that you've seen over there that you can share as lessons to entrepreneurs out there?
The failures tend to be bad financial management. If you run out of money, you run out of company. And if you don't understand that selling to supermarkets sounds great, but if they promise to pay you in 30 days, they wind up paying you in 90 days, then selling more to more supermarkets you're going to run out of money. And so you got to understand your financial flows. And that's probably the number one issue. Number two is weather, which is out of everyone's control. We're a food and ag company, so we are weather dependent. On the succeeding side, the biggest thing we see is the entrepreneurs that succeed have their eyes open, spot opportunities, and find a way to get that order filled, even if it's not perfect to start with. And then new opportunities pop up and new opportunities pop up. And so this is how we have a few companies that have grown 50-fold in 5 years or 100-fold in 5 years, or one of them's grown. Our biggest one's 180-fold, but that one took 11 years. But it grew from $100,000 to $18 million in 11 years. And they did that. Literally, a quick story as we run out of time here. Nobody was ripening bananas in Tanzania. You couldn't buy a ripe banana in any store in Tanzania. It just wasn't being done. And so our entrepreneur saw that opportunity, did the research on how you ripen bananas. And so right now, if you go to Dar es Salaam or Dodoma or Zanzibar and you buy a yellow banana, very likely it's a banana from Golden Banana, which is a brand name from East Africa Foods. And 70-80% chance that it's our banana as opposed to this was a green banana 5 days ago that happened to ripen.
A couple of questions that are coming. One is how someone can buy the shares. I think it's part of the reason why you listed in Mauritius, so people can access the market. So the East African investor, who's a good friend of Mwango Capital here, has asked how they can invest in your shares and where they can find information about the company, the annual report and all.
The easiest way is to go to Tuesday.Africa. That is the URL. You can find all the information you want about the companies at the bottom of the page. There's 3 links: Africa Eats, Elite Meat, and Zueto. That's the investor relations page with the share price history and every release, every announcement, and the listing particulars, like everything you need to know. And then that is also the website that hosts the app that lets you buy shares. If anyone wants to buy a significant number of shares, reach out to me here on Twitter. We can get you in where you can buy new shares that are issued. And then anybody is free to open a brokerage account in Mauritius and just buy shares. They're publicly accessible.
And if you wanted to solve one problem for most entrepreneurs that you've come across, what are some of the problems that you want to solve in the future, looking at the portfolio companies and the entrepreneurs that you've interacted with so far, from your perspective?
The problem I'm solving is I would like every single smallholder farmer in Africa to have an income. Hundreds of millions of people. That's the problem I'm solving. How do we do that is we raise enough capital to keep adding more companies to the portfolio so that we can reach across the continent and reach across all the different products, all the different food products that are grown that people want to eat. So we're covering cassavas in West Africa, and rice in Ghana and in every product everywhere. And so that's just a matter of scale. And it doesn't have to be us. Like one of the novelties of being an impact investor versus a cutthroat VC back in the States, we don't need to be the only one doing this. If we inspired 10 more Berkshire Hathaway-like companies doing food and ag and energy and fintechs and everything else across the continent, that's a win. I'm going to take that as a win and say that's great. So another thing we would love to do is inspire other investors to follow in our footsteps, not just other entrepreneurs.
And by the way, where do you draw the line in terms of supporting a founder and stepping in also to take charge of the business if they're not performing? Also, do you set KPIs for them? Do you work through them in terms of also aligning compensation structure to mission and vision of the business and Africa Eats as a whole?
So we don't fire entrepreneurs. It's their company. They run it how they want. If they fail to grow, they can ask us to help. If they don't want our help, if they don't want to listen, they don't have to listen. We don't jump in unless they ask for it. We're supporting them. We are not forcing anything upon them. We are the most bottom-up organization I know of on the planet. So they can ask for whatever they want, but we will not demand anything of them other than reports on how they're doing.
But then if they're not performing at all, can you watch a business go to pieces while your capital is invested in it?
Yep. Welcome to the world of venture capital and early stage investing. They're not all going to succeed. They're not all going to listen to the advice, even if we give them the right advice. It's their company, and there'll be write-offs. And there have been write-offs. We've had zeros. Doesn't matter. We've still grown the portfolio tenfold in 5 years. We've grown our share price 2.6x in 5 years, and that includes all the failures. That includes all the failures, all the inflation, all the devaluation of the currencies, all the things that go wrong. Yeah, and we've still grown from 3 million to 30 million in value in 5 years.
I'm just curious also about the due diligence you do in some of these companies then before they come into the portfolio. Your bar must be super high.
No, because we're investing in really young companies. So there just isn't, as compared to what other investors think is a reasonable amount of diligence. Yeah, when we're investing in a company that's $30, $50, $100,000 in annual revenue, of course we'll do diligence, but it's not going to take us months to do it. There isn't months of diligence to do.
I'll give you a chance to explain a bit your vision for Africa Eats for the next 10, 20 years. What do you see yourself accomplishing through Africa Eats, just for Africa as a whole and just for the world? And you also written a book. You should share a bit about it also.
Okay. I went to the annual shareholder meeting of Berkshire Hathaway in 2024. I was there with 40,000 fellow shareholders. I don't think we're going to get to that scale by the time I retire and when I'm in my 90s. But oh my God, wouldn't that be amazing? My vision is that we're in whatever the largest arena is in Nairobi in 2050 something, 2060. And there's tens of thousands of shareholders in the audience. We're announcing the latest and greatest of the portfolio. There are hundreds and hundreds of companies from, I don't know, maybe 30 countries across the continent by then. I'm not going to claim 55 by then. Total revenues of all these companies is measured in the billions by then. But we still are investing in companies that have 50,000 in annual revenues. We're still adding more of those to the portfolio, but our largest companies are now earning hundreds of millions of dollars per year, if not $1 billion equivalent per year. The largest companies are operating in 7, 8, 9, 10 countries. Yes, some of them are giant public companies that everybody knows their name, right? The Naivas's of the future. That's where this is headed. If all goes to plan, we will be truly the Berkshire Hathaway of food and ag in Africa. We're still focused solely on food and ag. By the 2050s, we're feeding, 2 billion people on the continent, right, of the 2.5 billion population. Like, we can count that up. Like, that would be the ultimate dream. And I'm 90-something years old, and I surprised my co-founder, Jumani, who's 80-something years old, and announced my retirement. Hopefully that'll come true.
Thank you, Looney, for the time and for the great information you shared. I'm looking forward for the next quarterly update from you. So we'll be sharing that as we receive them. Thank you for your time.
Thank you all for showing up. Thank you.
Thank you all for joining us today.